All right, we're back again with another episode of PFREI. I'm your host, Fuquan Bilal, a passion for real estate investments. Today, I'm actually in my office. Usually, I do these in my home office. The lighting is perfect, I guess, whatever. Today, we have Veena Jetti from Vive Funds. So we're going to get into it today. We're going to talk about some private lending and everything else. I'm really excited about this interview. So basically, just give everyone your background. How did you get started in real estate, and what are you doing today?
Yeah, so my name is Veena Jetti. I'm based out of the North Dallas suburbs of Frisco, Texas. I got started in real estate. I actually took the shortcut in because I come from a real estate family. So I already had like a very solid foundation by the time I graduated college. I did my degree in finance. I grew up in Chicago. And the first year my husband and I were married, I was working at the time for Tishman Speyer in DC. And we paid taxes married for the first time. And it was a lot. And I remember just going, oh my gosh, what are we going to do? We can't spend hundreds of thousands of dollars on just taxes. So ultimately, I ended up leaving my position in corporate America and opening my own company to start investing for our family. And so that was kind of how I started in our personal portfolio. Obviously, I come from a real estate family, so I've been doing around this my whole entire life. And so today I am a multifamily syndicator. I do large multifamily acquisitions. I actually just closed a deal recently in the last month or so that was 80 million, 494 units, which is our largest to date. And then I have a couple smaller assets in the portfolio that are like 28 units, 30 units. But the vast majority of our assets sit somewhere in that 150 to 300 unit range.
Awesome. So you mentioned a couple of things I want to ask you questions about, because I have a 18-year-old son who's learning the business as well.
Mm-hmm.
And it's pretty exciting when you see your children kind of want to follow your footsteps willingly, right? This is
Yeah.
something he wanted to do on his own. Of course, I did things along the way to kind of get him in the mindset of
Yep.
doing it. Like I used to drive around, collect rent, bring the
Mhm.
cash, count the cash in the car, get him excited. This is money we made. What are some of the things that your parents did to give you the influence? Like, did you just willingly say, I want to do real estate, or did you have other plans and then, you saw that was the best thing to do?
Yeah. No, so my parents did something very similar. Like I've been going to like closings and house like tours and property tours and everything since I was like, ever since I can remember, like five,
I
maybe, maybe.
used to hate it, be honest, because my
Oh,
kids
I
like, you
hated
going to
it so
another
much.
property? I don't want to go to another
I
property.
hated it. It was the worst. It was so boring. And I'm going to age myself because I'm like old enough that we didn't have smartphones when I was that
Yeah.
little. So it was like really, you had to like take a real book or you had to like take a coloring book or whatever. It was so boring. I hated it so much. But now I can actually like remember certain things from closings that I didn't think were like in deep in my mind. So, but yeah, so what did you ask me? I totally lost my train
Oh
of
no,
thought.
I was saying that, how does it
Oh,
helps
went
going to
into
did you
willing.
I was because I heard you talking about your childhood and you grew up in that type of environment. And I
Yes.
know it's really tough to teach your kids that business. So what I do as a parent, and I'm pretty sure your parents did, like you just mentioned,
Yep.
little things along the way to kind
Yes.
of plant those seeds to, build that encouragement.
Yes. 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 Actually, what I was going to tell you is because you said like, oh, you went into it willingly. So my parents tried to get me to go into it willingly. So I graduated undergrad when I was 20. So I was like a kid. I had no idea what I was doing. And I thought I was like so independent and like I have a degree now. I'm going to get a job. And my mom was like, great, you can come work for like the family business now. And I was like, I'm not working for the family business. I'm going to do something totally different and I am going to be on my own and I'm going to make a paycheck and I'm not going to work for you. And so then I went and got a job in corporate real estate and just made money for somebody else. And then I think my mom kind of had her moment, her like happy moment when I called her after we paid taxes and she was like, yeah, I kind of told you that this was going to happen. And so that was when there was like kind of that shift. And I actually didn't end up going to work for my family's business. So today, my parents, they retired early from their real estate portfolio. They divested from all of their holdings, and now I actually manage their holdings, so they're LPs into all of my deals now.
So they transition to more of a passive role, and that's what people usually do. They get tired running around. They figured out that the bank is the way to go, and that's my next question now is, you're raising capital for multifamily investing. And I keep hearing this multifamily investing theme. I've been doing this for 21 years, and I think the biggest unit I have is like 18 units, and some stuff, but I'm looking at now larger units. I never went that direction. I'm a single family guy. I do tax liens and also do some note business is my thing also. So I get the whole thing. But as I've been interviewing more people in multifamily, I'm seeing that a lot of people have transitioned to that, and it's just like so much better. I guess you have to get a few things down packed, but talk about your journey from getting started. You talked about you're managing your parents' funds and probably other passive investors' funds for these syndications you're doing with the multifamily. How did that transition happen? You just didn't start corporate and say, I'm going to buy a multifamily. Let's talk about some challenges you went through. Maybe you flipped the house and lost some money, or learned some challenges. I'm sure you put some bumps. Yeah.
All those mistakes I made. You learn something. Like even now, like I said, I closed an $80 million deal, and I still learned new things that I didn't know. And now I'm like, oh, okay, next time I'm going to do all of these other things. So I think it's always a learning process. As far as my parents go, they're mostly passive. They still do manage some active real estate. They can't ever really get out of it, right? And so they have a few real estate holdings now, but it's the only thing that they do. They don't, go to a 9-to-5 job or anything like that. So it's more of passion now. So some of the things that I've learned, so I started in single family also. I actually still have some single family homes, and I try not to buy more, but then sometimes this like really great deal will come up and I'm like, oh,
you're an addict.
I am. And I'm like, why are you emailing this to me? But it's funny because in multifamily, I can say no to like 99% of deals I see. I do like 1 out of 300 or 400 deals I look at. So it's a lot easier for me on the multifamily side, but on the single family side, I'm a sucker for the good deals like in my neighborhood and like things that are just easy wins. So some of the things I've learned going from single family to multifamily is, so multifamily is a lot more scalable. For me, I see it as a lower risk class or a lower risk asset because you're diversified, right, in your income. So even on your 18 units, if you have one tenant not there, you don't go to 100% vacancy, right? Whereas in a single family home, every time I have turnover, I'm at 100% vacancy that 1 month or whatever it takes to get that make ready done.
Good point.
So I think that is something that really attracted me to multifamily. And it kind of taught me the different like risk tolerances that I actually have within my own portfolio. And also the other thing too was like the scalability. I realized very early in that single family was not a very scalable asset class for me. So multifamily really made sense to be able to add, 100 doors at a time or 50 doors at a time or 200 doors at whatever that number is. You can kind of get to that scale a lot quicker.
Awesome. Why are you passionate for real estate investing?
I almost think it's just because I grew up doing this, but then my sister she's like a part owner of my company, but she does like all the stuff. I need someone I can trust, but she's not really like as into it as I am. She knows enough to be very dangerous. So I think it's partially that. I also think too, it's kind of the path to financial freedom. And which I care about because I want to spend time with my family. I want to control all of my own time, and I want to retire early, and I want to watch my kids grow up, and I want to be like a room mom and go on field trips if we ever like go out anywhere in public ever again. That's, ultimately that's my goal. And my husband's a physician, so he's like taking calls still. So I want to be able to kind of adjust that lifestyle. And we have been, as we've scaled up the real estate, we've been able to adjust on the personal side. So now, he works part-time. He's not, working 50, 60 hours a week like he was before.
That's awesome. What is your biggest challenge in multifamily? Question one. And question two, what is like your buy box? You mentioned 50 to 100. Do you see good deals below that? you know,
So
like,
actually my buy box is higher. It's 200 and up.
why?
Because again, it goes back to scale. But number two, there's a lot less competition for those assets.
Mm.
So when you're buying like a 500 unit asset, like we just bought, it was actually in Atlanta. There was one other family. It was a family office that we were competing against.
But don't you compete against institutional buyers also at that
We
level?
do, but our capital is typically more aggressive in some ways. And we also have once we start closing these deals, our capital doesn't get frozen because of a pandemic, right? So we just don't have the same amount of red tape to cross. And so I think too, like reputationally, like actually that might be the biggest thing I've learned is if you put a deal under contract, you close that deal. Like, period, end of story. There are very, very few exceptions. Like we've never retraded a deal ever. And, I plan to not start doing that anytime soon. And of course, there's going to be situations where you have to, but you should never put a deal under contract that you can't close on successfully because it gets around. It's the kiss of death in your markets.
Yeah.
So
The
yeah,
other one was, go ahead.
no, go ahead. Go ahead.
No, so the other one was challenges. You said your buy box are bigger because there's less competition. I would guess not only that, is it more work buying 50 units or 25 units? Because you like to have the on site and the smaller units, you don't have that on site, right?
Yeah. Yeah. That's why I like actually 100 units and up at a minimum. So I said I have a 28 unit in my portfolio. It's because I also own 100 units right next door. So it's really like 128 unit complex. So that otherwise I wouldn't own that 28 units because to your point, I want to justify on-site management. I think that in smaller properties or single family, my biggest challenge was the management aspect. It's so labor intensive that I couldn't scale that as much. And on the multifamily side, my biggest challenge is it's actually not the capital. My biggest challenge is actually in finding a deal that I'm willing to put my brand on because I'm so picky. So very, very, very few deals work for me. I invest into all of my deals alongside of my investors. And so I do that to establish that trust so investors know I have skin in the game too. And so I really want to make sure that when I'm doing a deal, I'm doing the right deal. I'm in a very lucky position that I don't have to do a deal to put food on my table. So I'm not choosing between like diapers or this deal that is like, okay. So I have the luxury of waiting until the right deal comes along and then doing just those deals. So I do very few deals compared to other sponsors that are kind of in that same asset class as me.
Got it. Are your deals set up where there's, how most people do single families, you hear is all these points and fees. People have a refinance fee, an acquisition fee, a management fee. Like, how do you, because I'm trying to wrap my head around that, trying to do it where the interest is aligned with the investor. Because of course, as the sponsor, you got to fly out and go see this property, spend your time with your team. So you should be compensated for that and reimbursed for that. But, how do you, like, give me a typical structure of one of the syndications you put together. Is it 2 points, 5 points?
Yeah, so it does vary deal to deal. So what I always tell investors is my projection. So if I'm projecting a 7% return or a 15% annualized return, that's all net of whatever my fees are, whether they're 20%, 2%, 1%. But typically a structure that you would see, acquisition fees can be anywhere from 2 to 4%. Mine are definitely on the higher side, but it's because I do such few deals that my investors know that they can like trust my brand on the deal. So I always tell them, you're not paying me just for this deal I put in front of you. You're paying me for all the 399 deals I said no to for you.
Yeah. I like that. Yeah.
So that's one. We do have a financing fee because obviously we're signing on debt, we're taking on risk there, and we put up the risk capital as well. There'll usually be a disposition fee. A financing fee can be industry standards anywhere from 1 to 2%. Disposition fee is anywhere from 1 to 2, maybe 2.5%. I don't really see that a whole lot. A refinance fee usually is about 1%. Maybe 2%. We usually kind of hover at 1%. And then asset management is the other big fee that I usually see. And that is typically 2% of gross receipts.
Okay. And that's basically the asset management fee is you're managing a property manager on site and everything else have to do with that. Yeah, that's pretty standard. All those fees you just mentioned, I see that's pretty standard in the industry. But it's I think it's an exciting times. I mean, let's kind of pivot a little bit to We're in a pandemic. We was talking about that before I press record, and this whole COVID situation. You have this mix. What I'm hearing, some operators are saying they are receiving a decrease in rental payments. Some of them are saying, "No, we're 98%. Nobody's paying late." People are not telling the
Yeah.
truth. But I'm seeing a lot more inventory on the market now. Like I see deals pop up. I'm like, wow, like opposite with you. I want to buy them all. You like,
Yeah.
you know what? You say 300 or 300. I'm like, oh, that looks good. And I call the guy. He's like, yeah, this is a $59 million deal. It was in Sweetwater, North Carolina,
Oh, I
and it
love
was
that.
out of 400 something units. And I'm like,
Yeah.
okay, that's a big deal. Like,
Yeah.
but with the rental, with the occupancy, what's the rental? Because it could be 100% occupied, but what percentage of those people are paying rent? So I guess that goes into all your underwriting. But
Mhm.
yeah, talk about that a little bit. How is that affecting your market, or how much more are you discounting these possible opportunities because of that?
Yeah. So to your point, I'm seeing way more opportunities today than I was 6 months ago. I think that's actually not an indication of the market, everyone being scared and selling. I actually think it's an indication of pent up deals. So, for example, people that were supposed to be listing their deal in like March, April, May have held them. And now they're like, okay, now it's time to, especially now that, the election's over, it's now kind of everything's starting to come back online. So I think that we are seeing a lot more deal flow. As far as rents go, my assets, for the vast majority of them, I'm actually not seeing a deviation from where we usually are in terms of like bad debt, delinquency. I do have one asset in the portfolio that is like, it's my problem child. But here's the thing, it's a short-term problem, right? Like we
Yeah.
are managing through this storm, and we're going to come out on the other end of it, right? So it's a matter of kind of withstanding the storm right now and the downturn right now. But listen, pricing has like not really changed all that much. I haven't seen cap rates move at all in any of my markets. And I'm in the Dallas, Jacksonville, Orlando, and Atlanta markets right now. I'm looking to add North Carolina and South Carolina, and then Tampa and Florida to my markets as well.
Yeah, that's awesome. I wish your typical in your buy box cap rate you look for. You're looking for 8% or greater, or
Oh,
like turnkey.
no, 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 no. I wish. No, I'm investing into like those solid B multifamily assets. So because
Turnkey, no value add.
no, I do value add
Okay.
typically, some amount of value add. I'm comfortable doing like a pretty heavy or decent lift, to more of like a yield management play. But typically it's somewhere like kind of right down the fairway. So we're seeing very low cap rates in our markets because we're in those primary strong markets that everyone kind of wants to be in.
Yeah.
So we're seeing sub 5 in most of our markets, but our operating cap rate that we can get to pretty quickly, usually we can kind of ramp up to that 6, 7, 8% pretty quickly over the hold period.
Yeah, that's
And the
awesome.
debt is great right now. So that's actually making a massive difference too to your operation, like your operational abilities.
Yeah, those cap rates, the 8% is more like Ohio market,
Yeah.
different type of market.
I like 8%. I haven't seen 8%.
That's
Like
a different type
almost,
of market. It's more aggressive.
yeah.
Probably C
Yes,
class, D
class. Yeah,
class.
we do like B
Yeah.
plus assets, institutional quality
So,
assets.
so you do B, maybe B, C, and A class areas, or B and A class areas, or
A
B,
and B
B
only.
and A and A B areas. Okay, all
Yeah.
right, yeah. See,
Yeah.
I'm learning the jargon. I'm learning the jargon.
I know, I'm impressed.
Yeah, I said I'm gonna walk around with some flashcards in my back pocket. I was just telling my team I'm gonna walk around with some so I can learn these terms and stuff. And
I mean,
yeah,
there's so many words. Like even when you know a lot of words, someone will use something, you're like, wait, I've never heard that said like that. What do you mean?
yeah. So I mean, what are some of the things you do to keep yourself up ahead of the market?
Yeah.
Do you watch special news feeds in certain areas? You're doing due diligence, like how you
Yeah.
know.
No, I just use my crystal ball and then I know, and it's like great. I recommend you get one. No, I actually study my markets for a very, very long time before I enter them. So if I'm entering a market, I've been looking at it for at least a year, sometimes 2 years before I've entered it. I also look for operational partners that have strength in that region. So if I can JV with somebody who already has a portfolio, or a management company that already has a significant portfolio in that market, or if one of my partners is from that area, that speaks a lot to me as well. So that's kind of what I look at when I'm going into these areas. But I really I'm studying everything, and I look at. I don't actually just look at real estate trends. I also am looking at so because my husband's a physician, right? I actually look at medical trends a lot too.
Hmm.
Um,
Wow. Okay. Yeah. Give me some KPIs. Give me a couple of
Yeah.
KPIs.
So, medical offices, depending on the area you're in, big hospitals, they don't set up offices or hospitals in areas that there's not a big patient population. And depending on the hospital system that's coming in, you're looking at certain payer mixes, meaning that certain people have insurance, and usually insurance means that there's a certain income level, which really fits my demographic that I go after. So, those are things that we kind of look for as just kind of a little bit different, maybe than what other people are looking at. We also are looking at what are the major headquarters moving in or regional offices moving in. So, for example, I have one asset, and like a week after we closed, Wayfair announced it was putting a massive industrial warehouse like a mile and a half from that asset.
Yeah, I love Wayfair.
Yeah, who doesn't?
Yeah.
And so things like that, that's great for us, because when like a Costco or a Lowe's or something like that puts up a building, they've studied that market they've done feasibility studies for like 18 months, 2 years, and they've looked at thousands, if not hundreds of thousands of data points over the course of time. And they've decided that those locations are areas that they're going to be profitable, right? And so I like to look to those also as another indicator for us that these markets are growing markets. And then, of course, diversity of jobs in each individual market. Like, I don't want to be in a market where it's only one sector, like oil and gas, right? I also don't want to be in a market that doesn't have any growth potential or isn't growing. So I tend to look at more of that Southern and that Sun Belt area.
That's awesome. This was a great interview. I'm learning so much. Thank you.
You're welcome. I'm glad I could be useful. I've earned my keep.
It's awesome. It's another great episode. PFREI, a passion for real estate investments. I'm your host, Raquan Bilal. Let the people know how they can get in contact with you if some people want an opportunity to do a JV with you or learn more about what you're doing.
Yeah, you can find me on my website at vivefunds.com, VIVE funds, FUNDS.com, or you can find me all over on social media under Veena Jetti, VEENAJETTI.
All right. You on IG?
Yes, I'm on Instagram. Begrudgingly, though. I actually hate Instagram.
What's your handle?
Veena Jetti. Super easy.
VENA. All right. Oh yeah, super easy. Found you. All right. I'm following you.
All right. I'll follow you back.
Wow, you're doing pretty good. You got like almost 10,000 followers. Wow.
I don't ever post anything. It's like all quotes, and
I see it.
someone runs it for me. I don't even run my Instagram. They'll forward me messages, and I'm actually a Facebook user more than anything.
Yeah, it says be a first rate version of yourself, not a second rate version of someone else. I like that. These are good. Appreciate it. Thanks for coming on the show. Passion for real estate investment. Guys, check us out on Instagram, Twitter, and all those other social media handles. This was a great interview. Thank you, Veena. Appreciate it.
Thank you.